Have you ever imagined waking up in the morning, opening your bank account, and seeing that your wealth has grown, even while you were sleeping? For many adults between the ages of 30 and 50, the idea of relying solely on active work or public retirement creates a constant sense of insecurity. After all, how long will it be possible to maintain your current work pace? And what if unexpected events arise? The good news is that there are proven strategies that allow you to build sources of passive income, creating financial stability and a comfortable retirement without sacrificing your quality of life. In this video, you will learn how to make your money work for you through methods that combine safety, financial intelligence, and growth potential. We will explore data, charts, and real projections that show how passive investments can transform your relationship with money. Stay with me until the end, because I will reveal the most effective paths to achieving a freer and less stressful life, starting with decisions you can make today. For most of our lives, we've been taught that the only way to earn money is by working, trading time for salary. This model, known as active income, works as long as we have health, energy, and opportunities. But over time, it becomes risky and unsustainable. What happens if you lose your job or can no longer work? Moreover, public retirement, which should be a safety net, is often insufficient to maintain the desired standard of living. Recent data shows that in many countries, the average retirement income corresponds to less than 60% of the active salary, creating insecurity and concern for millions of people. A simple chart showing the evolution of active income over the years reveals that after age 50 or 60, the ability to generate income tends to drop drastically, while health and quality of life expenses increase. In this scenario, passive income emerges as an indispensable solution. But after all, what is passive income? It is a source of revenue that does not depend directly on your continuous effort. Unlike active income, where every cent is tied to your time and work, with passive income you invest initial effort or capital, and then the returns keep coming automatically. Among the main benefits are financial stability, the possibility of independence, and even early retirement. To illustrate, imagine someone investing $200 per month for 20 years, with an average annual return of 8%. At the end of this period, they will have accumulated enough wealth to generate a comfortable passive monthly income without needing to work actively. That's the power of compound interest and financial discipline. Now that you understand the importance of passive income, let's explore the 5 most efficient types of investments that can put your money to work for you. The first is real estate investment trusts, also known as REITs. They allow you to invest in enterprises such as shopping malls, hospitals, and logistics warehouses without needing to buy a property directly. The great advantage of REITs is the possibility of receiving monthly income generated by rental payments. Additionally, they offer diversification and liquidity as they can be bought and sold on the stock exchange. But like any investment, there are risks. Vacancies, defaults, and changes in the real estate market can impact profitability. For example, an investor who allocates $20,000 to a REIT with an average return of 0.8% per month could generate a passive income of $160 monthly without needing to deal with tenants or property maintenance. The second type of investment is dividend-paying stocks. Solid companies with consistent profits often distribute part of these earnings to shareholders in the form of dividends. This is one of the most traditional ways to generate passive income in the financial market. The advantages include the possibility of growing wealth through stock appreciation and receiving recurring dividend payments. However, the risk lies in stock market volatility and fluctuations in company performance. For instance, companies in the utility or banking sectors traditionally maintain strong profit distribution policies. A shareholder who owns shares in a company that pays quarterly dividends, for example, can count on regular supplemental income, increasing their financial security. The third investment is public and private bonds, especially those that pay periodic interest. In the U.S., these include treasury bonds and municipal bonds, offering real returns above inflation with semi-annual payments. The key advantage of these bonds is security, especially when it comes to government bonds, which are considered low risk. Moreover, they offer predictable returns, essential for those seeking financial stability. On the other hand, there are associated risks, such as inflation and liquidity, which can be limited in certain cases. To illustrate, an investor who applies $10,000 to an inflation-linked treasury bond with an interest rate of 5% per year, plus inflation will receive periodic passive income protected against loss of purchasing power, ideal for those thinking long-term. The fourth type of investment involves automated businesses. Unlike the previous options, here we are talking about ventures that, once set up, can generate continuous revenue with minimal intervention. Examples include online stores using dropshipping, digital courses, ebooks, or apps. The main advantage is scalability. An online course, for instance, can be sold to hundreds or thousands of people simultaneously without increasing operational costs. The risks involve the need for initial investment, both in capital and time, as well as the need for periodic maintenance to ensure product or service quality and relevance. To illustrate, think of an entrepreneur who creates a digital course on personal finance. After the initial effort of production and marketing, the course starts generating sales automatically, providing constant passive income. The fifth and final investment is private retirement plans and pension funds. This is one of the most traditional long-term planning methods to ensure a comfortable retirement. The main advantages include the possibility of accumulating wealth in a disciplined way, tax benefits in some cases, and the security of having future income. However, it's important to be aware of management fees, which can erode part of the earnings, and the flexibility, which tends to be more limited compared to other investments. For example, by regularly investing in a 401k or IRA plan, the investor can enjoy tax-deferred contributions and accumulate a significant amount to be used upon retirement. Now that you know the main types of passive investments, the question arises, how do you choose the best path for you? The answer depends on three fundamental factors: your risk profile, your age, and your financial goals. More conservative investors tend to opt for government bonds and private retirement plans, which offer greater security, although with more modest returns. Those with a moderate or aggressive profile may include stocks and REITs in their portfolio, seeking higher profitability but also assuming more risk. Diversification is key. Combining investments with different levels of risk and return helps balance security with growth potential. Imagine, for example, a 35-year-old with a moderate profile who decides to allocate 50% in fixed income, 30% in dividend stocks, and 20% in REITs. This diversified portfolio increases the chances of long-term success, providing passive income and simultaneous wealth growth. While investing to generate passive income is a powerful strategy, there are common mistakes that can compromise your results. The first is believing in promises of easy money or miracle investments that offer sky-high returns without risks. That doesn't exist. Every investment involves risks and requires study. Another frequent mistake is neglecting the costs and fees involved, which can significantly erode earnings over time. Additionally, not reinvesting profits, especially in the early stages, can limit the growth of your wealth. Therefore, the recommendation is always to maintain a cautious, informed, and disciplined approach, continually seeking to learn more about the financial market. If you want to start building your passive income, the most important thing is to take the first step, even if it's small. Define your goal. How much do you want to receive monthly in passive income in the future? Then, assess your investor profile and study the available options. Choose one or more modalities that make sense for your objectives, and start with amounts that fit your budget. The fundamental point is to be consistent and, whenever possible, reinvest your earnings to accelerate the growth of your wealth. Remember, the best time to start was yesterday. The second best time is today. Today, you learned how to make your money work for you by building sources of passive income that can provide a freer, less stressful life and a comfortable retirement. If this content made sense to you, subscribe to the channel, turn on notifications, and follow our next videos on financial education. And now, I want to know, which of these passive income strategies do you plan to explore first? Leave your comment below. See you next time.